אהלן גלעד, good afternoon.
אחר הצהריים טובים, שלום, מקליטים יום אחרי יום, לא יודע אם נפרסם אחרי יום או יום, אבל זה נראה לי כיף כל יום להקליט אצלך פרק.
אין בעיה, בכיף גלעד. תמיד כיף לנו לדבר, רק צריך גם לעבוד תוך כדי שיהיה לנו דברים חכמים להגיד.
Yeah, we're going to say hello also to our friend. We have a new friend today. Hello, David.
Hello, nice to be on the show, guys. Thank you very much.
Thank you very much for coming. Now, I'm going to speak in English to our audience. I hope you'll understand. And guys, David is, how old do you say you are? 28, right?
Yes, turned 29 in July.
29 in July. So you're still 28. And although he's young, he made a great impression on Yoav in some conferences that they've been in the last few years. And actually, Yoav sent me some things that David is writing, and we put them in the newsletter that we sent to you in the past. And we really, really like his approach and the way he looks at things. So David made us the honor and come to talk to us about his philosophy, how he sees things. He's only in the beginning of his career. He actually established his first fund 3 months ago, right? In November 24?
Yes.
Congratulations.
I'll say in Hebrew, אבל דיוויד היה בכנס האחרון של גיא ספיר, הוא הוזמן שם ונתן גם הרצאה, ובחרתי לכם לדעתי את אחת מההרצאות הטובות והמשקיעים החכמים ביותר שהיו שם. אז אל תתבלבלו בגלל גילו. David, I just complimented you, say thank you, and that's
was
it.
a very nice compliment. So you remember where you heard him first for the Israeli audience. אבל אנחנו נתחיל מההתחלה, חברים, אנחנו לא נותנים המלצות השקעה ולא ייעוץ השקעות ולא שיווק השקעות. אנחנו רק נותנים פה ידע למטרת לימוד. כל מי שרוצה ייעוץ צריך לקבל ייעוץ בהתאם למצבו האישי, מוזמן לפנות ולקבל. לא לבצע פעולות על בסיס מה שאנחנו אומרים, אנחנו אך ורק רוצים לגרום לכם לחשוב בצורה יותר רחבה, אז קחו את זה בפרופורציה, גם לי, גם ליואב וגם לדיוויד, יש עניין במניות שאנחנו מדברים עליהם, אז תזכרו גם את זה, ויש לנו נותני חסות למטה, אינטראקטיב, פספורט קארד, אתם מוזמנים להירשם שם ולעזור לנו לתמוך ולקדם את הרעיונות שלנו, ואנחנו מוזמנים גם להירשם לניוזלטר שלנו, ומי שרוצה לייעוץ עם יואב, יכול להירשם, גם יש לנו לינק למטה, הכל מופיע. אז תהנו, אוקיי, I just gave them, David, a small disclaimer.
I don't speak a word Hebrew, but that sounded like a disclaimer.
Yes, I can understand. And some sponsorships. And we can now start with our quotes. So we would like to give you the honor, David, to give the first quote for this podcast.
Great. I will pick the quote that I also display on my blog, and I think it describes my contrarian investment strategy very well. And it is from Howard Marks. It says, the safest and potentially most profitable thing to do is to buy something when nobody likes it.
Great quote, and we go into depth about this philosophy. Yoav?
Gilad, you wanted to stay with the same guy, so I think you should start today.
Okay, I'm continuing with Marx as I'm reading his book, and I'm in the chapter about cycling, and he says like this: rule number 1, most things will prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1.
Nice. Classic Marx. So I'm gonna do something different. I'll bring a philosopher, Seneca, who said a long time ago, so long as you live, keep learning how to live. So again, okay, I'll say in Hebrew, כל זמן שאתה חי, תמשיך כל הזמן תלמד איך לחיות. To improve and to become, live a better life.
Wow. It's not the simple things to learn how to live.
Yes.
Usually we just do it without thinking, like breathing, we're just living, but how to live, it's a complicated task. I don't know.
It was a deep one.
I don't know if ChatGPT will tell us the answer to what's the best way to live your life. That's interesting.
True.
Okay, Yoav, I'll start with a question to you.
Sure.
Why did you want to bring David to this episode?
Why did I want to bring David? First of all, David and I have a common friend who we have to thank for connecting between us is Shmuel, who's a great investor on himself. And he told me a long time ago, when you go to the conference, this was, I think, in the conference or before this one, find David and talk to him. And I read his blog before. And David is, you know, when he writes, he makes it sound so simple and logical, and I think that's I think that's what we're trying to do here, to make investing so to make it something methodical that makes sense, and even myself, as I call myself a professional investor all the time, to read and to become better is what we're trying to do. And then when we read David's stuff, it emphasizes that. And the most important thing, our largest position was the same. So that also was an interesting Teravest that we talked about. And in the last conference, David was kind enough to give me credit for an idea he pitched. So I had no choice to bring him on the show.
Okay, and I'm going to complete this notion, because when Yoav sent me David's blog to write, and Yoav sends me a lot of things to read. I can't finish reading them all, I'm not that capable. But when I come about to reading David's blog, I was really, really impressed. And then I replied, Yoav, you need to write like this. It's so good. And I'm going to share with you the website of David's. It's called Contrarian Cashflow. We're going to soon ask David why this is the name he chose. But when you see on his blog, you can see his portfolio updates, which used to be public until November when he established his fund.
אבל מה שאנחנו מראים עכשיו עדיין אפשר לגשת ונרשמים, רואים בחינם.
Yeah, but this is updated to December.
I'm sure David doesn't make
if you want to continue update to see David updates, I think you can subscribe with pay. We're going to ask David in a minute. And what I loved about it so much, besides the way it's written, and it's very interesting, that he gives us very, very clear picture of his portfolio. You can see it here. You have the company name, the percentage of the portfolio, what's the return that the company gave since inception, owner earnings yield. I'm going to ask him soon what it is, implied growth rate, implied shareholder yield, implied total return, and all the thesis for the investment. You can go in here and see the thesis, why he chose to hold this company, what he believes. It's very, very thorough, very, very organized. And I love it so much when everything is so clear, accessible, and
like a true mathematician. David comes from a math background, so it all makes sense.
So
the one,
first
by the
I'll
way,
say
the one that you clicked on was actually not
something else, Gilad.
Yeah,
that's a future guest, but that's okay.
Anyway, in the third row,
I don't understand. This is
click
what?
on the
click,
click on the third row. I mean, those I haven't done write up on any of them, not on all of them. That, for example, the third row, Lindbergh, one above.
Yeah.
That one is for me, for example.
So this one you took from
I took from someone else.
Okay, it's good enough.
Very smart, very smart investors, but it's.
But you emphasize the thesis. It's good enough.
Yeah.
Okay, David. So we compliment you enough. Tell us a little bit about yourself. What have you managed to do in the last 28 years upon Earth?
I mean, first of all, you guys are way too kind and give me way too much credit for what I do. It's just I have to make things very simple because I think I'm maybe not smart enough to do the complex stuff. So I try to make it as simple as possible so that I can actually execute on it. I mean, my background is I studied mathematics. I'm a mathematician by education. I actually started as a working student in my bachelor's degree. I worked for the asset manager of Munich Re, the large German reinsurance company, and I worked as an analyst in the asset manager. And it was from what I had very good colleagues, but it was maybe not the best experience because I found out how bureaucratic these asset managers are, and it has nothing to do with intrinsic value. And during the same time, I learned about obviously Warren Buffett, Charlie Munger, and Benjamin Graham on how to invest based on fundamental principles in companies, and that made a whole lot of sense to me. And then I just couldn't figure out how these bureaucratic institutions actually manage money. And short after, I made the decision maybe that the institutional asset management industries is not the route for me to go. So, I mean, being a mathematician and having my bachelor's degree, I decided to switch topics because I thought, okay, if it's not finance, I mean, what can you do with math? And I mean, back then we didn't have ChatGPT, but artificial intelligence and machine learning is basically scaled mathematics. And I thought learning how to code and how to program wouldn't hurt either. So I decided to do my master's degree in mathematics and data science. Did this for 2 years and then worked 3 years for IBM as a data scientist and machine learning engineer, actually. But I mean, ever since I learned and read about Buffett and Munger and Graham, I started to invest my own money and learned all the principles, read a lot, and I'm a self-taught investor. And over the past 6 years, I mean, I made all the mistakes in the beginning that someone who doesn't know what he's doing maybe has to make. But over the past 6 years, my process got better and the returns got better. And over the past 2 years, I figured out I work a full-time job and then I work another full-time job in investing on top. And and I thought maybe that's the sign that I should pursue it professionally. And this is the reason why I started writing the blog that Gilad, you kindly mentioned approximately a year ago. And I got some interest for family and friends if I could do something for them. And this sparked the idea to manage the money for them. And this is why I launched the firm. Currently, it is I only privately manage the money in the firm, so it's not a public asset management firm or something. But I mean, it depends on the interest. If there is enough interest, I would think about launching something in a partnership form for external investors. But just the background. And I mean, many people ask me how I apply data science and AI is such a hot topic to my investing, and I always have to say that I actually don't invest in tech and I don't use AI for my investment thesis at all. It's quite the opposite. But as you and Gilad, you mentioned, it's what I take from my background as a mathematician is just a very methodological view and process, because I see investing, as both of you know, it's a very weird profession. If you think about it, that not only like the payoff for your quality of your investment, your returns are hugely influenced by luck and randomness. That's one problem. So like it's very hard to distinguish between signal and noise. And the second thing is that you actually get
Howard Marks said something that stayed with me for a long time. He said the investment world is filled with people who was right from the wrong reasons.
And that is absolutely true. And that's why I said, like, usually the signal, if you have done something right or wrong, you get maybe 3 years delayed. So like that makes it a very difficult environment to operate. So my viewpoint is, I mean, the only thing that we really can control is our process. And we have a process and execute the process. We can get the feedback, and then we can work backwards to where the process was not good enough. And this is how we improve. So this is what I basically take from my profession, because actually that in data science is it can be pretty much the same. If you have a huge pool of data, I mean, you can fit a model to the data if you want to, if there is enough data. That is very simple. But I mean, you have to find the signal and the noise, and this is why you have a methodological process. Then you build a model, you watch it how it performs, and then you reiterate. And I think that's
so
the major thing.
We'll go into your model in a minute, but first, please tell us what's Contrarian Cashflow. Why did you choose this name?
I think first of all, if you have an alliteration in your name, it's always a little bit catchy. But the most important thing is, I think the two words describe my two most important, let's say, from a philosophy point what I'm looking for. I think, as I mentioned in the quote, in order to get an outsized return in the market, you have to do something different. You have to do something different than the market is anticipating, because if you want to have an outsized return, I mean, our friend Mark said, you have to be contrarian, but you also have to be right. And I mean, contrarian is the first part, and the second part is cash flows. It's especially if you hunt in the small company space, like I am, it's very important that, or I think it's very important to focus almost like a private equity company would look at a business. It's you want to generate your return from the business itself by the cash flows that it generates, because you cannot.
Please elaborate.
Yeah.
Please elaborate about this sentence. What do you mean by create your revenue from the business itself?
Okay. If you look at value investing, how it has been pursued for a long period of time, is you buy something that is undervalued by whatever metric you use, and then you wait for the market to appreciate or your way or what you see in the company, and re-rate the company and applying a higher multiple to it, and then you generate your return from the re-rating of the stock. This is basically a function from the stock market. So if you think about when you buy shares in a public company, you can generate returns in three ways. The first one is, as I mentioned, the stock can go from a 10 times earnings to a 20 times earnings, then you make 100%. The second one is the company pays a dividend, so you get the yield, or I think a share buyback I consider is equivalent to a dividend yield, or it can reinvest and grow. So in my opinion, the first one, the re-rating, you cannot really control. It sometimes is random. It moves widely day by day. Maybe some traders can, but I can definitely exploit that factor to generate returns. And this is why I focus on the company. So if I buy a company, and you mentioned like this is why I made the portfolio, is that like there is an owner earnings yield, there's a return on equity. I mean, the philosophy is quite simple. I want to know what does the company earn on a cash basis when it wouldn't reinvest in itself, basically just maintain its operations. Basically, like you would buy an apartment building as a real estate investor. What rent would you get if you don't have to? You just maintain the property, but you don't reinvest. You don't make it more beautiful. Like you just get the rent. This is how most real estate investors would actually look at it, and then you know what is the yield that you get, like the cash yield. And I want to get this view on the company. So you want to say, okay, when they would just survive and maintain the business, what could they pay out? And
so you want basically to try to overlook the growth and overlook the multiplies expansion, and you don't want to count on the market to understand the value or changes. You just want to see that it's a good business by itself.
Exactly, it's a good business by itself. I mean, growth is an important variable, but I think growth rates are very, very hard to predict. It's very, very hard to predict where growth will be. So what I think is, okay, if the company runs out of capacity to reinvest and grow, what could that's basically my bottom line, my bottom case. If they cannot grow, what can they pay out? And I think that's
the margin of safety one.
Exactly, that's the yield that you would get if the business would just muddle along. And if that yield already is high enough to get
anything else is a cherry on top.
Exactly, you get a good return. And then, I mean, Gilad, that's what I said about growth is if the return on capital that they have, the return on invested capital is high enough, like high enough is usually above their cost of capital, and usually it's around 10% for equities. So, and every dollar that they can reinvest to grow, because there is capacity to grow, will improve your return, because the return on invested capital is higher, and every cent that they can reinvest will improve your return. But I don't want to rely on that. I think it's just very, very hard to rely on capacity to grow, because it's just very hard to forecast demand and industry dynamics. So especially in small companies, because I mean they are by nature not that stable as large companies. So what I see is I want to protect my downside, and this is also about the multiple. My philosophy is if I buy at a cheap multiple so that I get a good yield from the company itself, and they have the capacity to grow, then I know my bottom line, and if that's good enough, then once they reinvest and grow, the multiple usually would go up as well. But I don't have to have an opinion in that. That is just my upside. And my philosophy.
David would probably not invest, even though he heard of this pitch. We heard it together last year of the Australian KPG, the company we talked about last episode. And we talked a little bit about growth and everything. You probably would not, at this price, buy such a company. Correct me if I'm wrong.
Exactly. No, that is true, because I think, how I think about a multiple. If you pay a multiple on earnings 10 times and you have a 10% discount rate, you have to wait basically 10 years until you get your money back. The higher the multiple, the longer you have to be comfortable or forecast the cash flows.
If there isn't any growth.
But even if there is growth, if you think you pay 30 times cash flows, you either would say that the company can grow very fast or for a very long period of time. Statistically, high growth rates don't last very long. And maybe people are more better than I am, but I cannot forecast growth
Most
rates.
people aren't able to.
In 10 years. So.
Even if you think you can, we can definitely agree that this is a risk.
It is. It is
a risk. Even when we talked about KPG, we talked about that when we buy it, we estimate a very strong growth rate, and maybe it will happen and maybe it's not. And maybe it won't happen because the business plan won't work, and maybe because something external that might intervene. It is a risk, definitely. I understand.
Exactly. And usually how I think about it is if the market anticipates growth, i.e. trades at a high multiple, if it cannot grow that fast, if the market expects a 30% growth rate, but it only grows 20%, which is still phenomenal, usually the stock gets sold down very, very strong because the tail end of the cash flows is so sensitive to the growth. So I just flip it on in its head. If I buy something that is not if the estimate is just that it would grow, but by analyzing the company, say, okay, maybe it's not growing now, but the business is improving, so at least there's the capacity to grow. So then I get the surprise to the upside. And that is something that you cannot forecast, but you can position yourself to benefit from the upside and not being hurt by the downside.
Very interesting. Okay, you talked about a very organized process that you stick to. What is your process? Can you describe it to us?
Sure. The idea generation process where I find ideas is very unstructured. That is important. That is by design as well, because I think it is important to get exposure to all different aspects, talking to people. Sometimes I screen, I read, because if you only have one source of idea, I think you run the danger that you introduce a bias in your research process. And the bias, you may be missing something, and then you're only exposed to that. So I want to get a wide variety of ideas. Usually I screen through them, and then I skip most. And if something's interesting, I will...
But can you tell us a little bit what's that variety of places that you source ideas?
One idea is, like most of us do, like I run screeners. I usually don't run screeners for very good companies, because everybody can screen a high ROIC, a high growth company that trades expensively. I usually look for cheap companies that trade sometimes below book value, or they have issues, because when I go through them one by one, 9 out of 10 really have issues, but 1 out of 10 you think about, wait a second, there is a moving part, there is something happening that the market might misunderstand, and then I have the opportunity to buy from that.
David, maybe if I may interject or just add something, I think another German investor, he has a website called QUANT Investing. I don't know if you know him, but he wrote even a pamphlet, not a book, and he he's more of a quant investor where he uses like the magic formula, those kind of ratios. But the best ratio over time, and this connects to your strategy, is one where he does free cash flow yield, where he screens companies from all over the world, and the ones trading at the lowest free cash flow multiple, and he buys a basket of them. So you would just look at this list, and I'll put a link in the show notes to his website. I don't know if you're aware of the site, just for free as well. And then from there, you might get good ideas for companies. And this strategy over time, not everybody's going to have the mathematical mind you have to analyze each of these companies. Buying a basket of these over time is a great strategy if you can take and rebalance once in a while and take the volatility that's part of the process.
No, absolutely. And I mean, what I currently read, it's from Dan Rasmussen, The Humble Investor. It's a pretty new book.
I just started reading that one.
Yeah,
it's a good one.
I mean, he said also, like, if statistically, like, there are two factors that work over long periods of time. It's the value factor. You buy just very cheap companies, and the one is the profitability factor, or the quality factor. But it's very important. He mentions that it's just profitability. It's not growth, because you cannot forecast growth. So my intuition is if you buy something cheap and that is profitable, you are already in a good pond to fish in. So that's the idea.
But basically, if I need to explain what you're doing in simple words, you're going to the flea market, going over all the cheap stuff, trying to find some really fine antique things that worth much more, and the people just don't know it's worth it because it's old.
Yeah, exactly. Or maybe there is something old around it, and if you rub it off, it's actually this is something that I find interesting.
It reminds me of Brad Jacobs from XPO that we talked about. And tell him you want the hairy deals, the big and hairy deals that you can fix the hair. If you find a deal with a problem and you can solve the problem, you create value and you make a good money out of it.
Yeah.
Okay, so you go from
that's the funnel.
You do screeners for the flea market, you would call it. What else?
For example,
what else do you source your ideas from?
I have investors that I talk to, like Yoav. I mean, he said like that was one of his ideas. I mean, that's always it helps to talk to smart people. I read I follow a couple of managers that that hunt in the same pond that I do. Then I read those. Twitter can still be a good way to find ideas, just scrolling, like if something comes up.
Okay, so we'll talk first. Sorting is cloning, finding from good ideas from other investors.
That helps. I mean, from my experience, you still have to do the work. It's hard. You can you can clone the idea, but you can't clone the conviction. And I think that's absolutely true. But it helps to spark something. And I mean, if other people
just to source the idea that you choose.
Exactly.
So, but what is your universe? What is your pond? What do you look for a company? I mean, we already understand that you want something that the price is good. It doesn't rely on any growth. But do you like big companies, small companies, special industries?
I mean, mostly I would do small cap or micro cap. So usually under $1 billion. I do mostly developed markets. Currently not in the US. I mean, because it's just, I mean, the opportunity set doesn't seem to be there at the moment, but that's just a current snapshot. So Europe, North America, Australia, that's the major areas that I'm looking for. I want to have industries that I can understand. I wouldn't do like some people, I don't do biotech, I don't do XYZ. I don't have a definition like that. If it would be a biotech company that has a business model or a strategy that I can understand, then I would do it. I wouldn't, if they want to develop a new drug, I'm maybe not the right person. But if they have like a platform model that makes sense and that I can buy cheaply, I would do it. But naturally, I tend to do more for that reason in, let's call it, more traditional industries, like industrials, maybe some technology, but only not the high flying technology. I like distribution companies, professional services companies, because especially in the small space, it is very, I mean, if you have a small company, I fundamentally believe that small companies cannot have a moat because they're too small, and someone with enough capital can disrupt them if he wants to. So you need companies that dominate a small niche where there's just not the capacity for large companies to invest, which won't make it not economic for them. And you can find a lot of niche manufacturers, you can find niche distributors or professional services that just do a very good job servicing a niche. And if you do a very good job over a long period of time, you create something like a moat or a competitive advantage. I think Rob Vinal, he had like a video like where like sources of moats, and I think one has especially stuck with me. And he said like a moat, like a long series of many years of execution lead to a moat. So if you have management over a long period of time does a very good job, this creates a moat. And I think that is something that resonates deeply with me, because it's not always tangible. But if you see companies servicing their customers very well in a niche, demand a fair price for the service, doing it for long periods of time, that is something that is very hard to see from the outside. Like, what is it, what they do? But you see it usually in the numbers. And if you talk,
you brought us an example of one today, right?
Exactly.
We'll get to that later, I hope.
Exactly. No, and I think that's what I'm looking for. And the process, finally coming through the process, I have 5 tenets. You can even find it on the blog. There is a checklist. It's 5 tenets that I look for. It has to do with the business itself, like the business quality, the market it operates in.
What does it mean, business quality?
Yeah, I would go like I would just name them, and then I go, okay, I can go deeper. It's the company, the business it operates in, it's the financials, and it's the valuation.
Long-term strategy, I think, is the one.
Strategy. Yeah, I mean, what is business quality? I think, mostly it is, I want to have a business that, it's basically what I just said. Is I want a business that manufactures something that or performs a service that is somewhat crucial to the customers, and it can earn a good price and a good return on that. Because with moats, it's very difficult, but it has to be self-funding, so it doesn't rely on external capital. And if it can grow or not, yeah, I mean, that's basically it. It's not that strict like others say, like you need a wide moat. It's simple as that, and because it's a larger picture, the entire framework. It's a strict process, but it's always a combination of different factors. So, what is the market? I don't, or that way, I don't need a high growth market of anything. I just want to have a market that is at least stable. I think it's difficult to make money in declining industries. It requires special capital allocation. It's hard to work with a headwind. It's just more comfortable with the tailwind. But the second point is way more important. I want to have a market that allows for product or service differentiation. So if you have a oil and gas exploration, oil is oil. It doesn't really matter where it comes from. So if you have a market with a product or service that you can differentiate, it's much more simpler to create a niche where you can earn a good return, because you can pinpoint what you do and fine tune it so that customers want to pay more for it. So that's.
Can you give us an example?
Sure. For example, like I own, for example, a small manufacturer in Italy. They make transmission systems for agricultural vehicles. So you can say, like, is it a commodity product because it's a transmission system? So many businesses can do that, but you can do something in a different way with a different quality to it. So they make the best transmission system in the market, and this is why all the John Deeres and also in the industrial space, the Caterpillars want to work with them, because the performance of a transmission system is crucially important to a tractor. So you can switch components between providers, but the one would break early. So, and if you have like a commodity like oil, like, is there any major difference? It's the commodity.
It's something like an alpha of the product.
Yeah, exactly. And it can be like very measurable, like a performance of a part. When does it tear? But it can be soft. A brand, for example, can be the same, or a quality of service. So this is what I mean. Like you have something that you do that if someone else does like quote unquote the same thing, the customer can still distinguish, and you can position yourself to offer something differentiated. That's what I mean by that. And I think that is crucially important to earn a good return on your capital. So the first two, then the financials. So yeah, as I alluded on, if you have a good return on your capital, I want the business to self-fund its operations. So by their operating cash flow, being able to reinvest it into the company and not relying. I mean, I don't mind debt, but I don't like too much. If you need debt to earn a good return, like your business model is not good enough. You have to leverage your returns. That not only makes you fragile from a balance sheet perspective, but it also it leads to a worse position actually with your customers, because if your customers know that you over-levered, they can squeeze you because you need the next revenue. You cannot say, I won't do business with you because I don't have to. They know that you have to. So that's like, I think many people don't look at it from that side, but I think that's a huge point. And that's mostly it, that they have to be self-funding. They have to manage their working capital and generate free cash flow, because that's the centerpiece of my investment philosophy. They will have to generate free cash flow. Then, I mean, the fourth one is management. I mean, or you have mentioned strategy. Management is, especially in small companies, hugely important. You can argue that a good CEO or a bad CEO in a company like Visa or MasterCard, I mean, you can always destroy a good business, but I think it's very, very difficult to destroy a business like MasterCard.
We always need to remember that AIG went out of business.
True.
It needs a lot of capability to destroy a good business like this.
Exactly.
You need to be really talented in order to destroy it. It's not like a normal stupid. You need to be like PhD of stupidity in order to ruin this business.
Exactly. But on the other hand, even if you have a brilliant CEO, I mean, how much can you really improve the already very, very good business? But with a small company, it's quite the opposite. Like a good manager, an owner operator, he can really drive a business. Like he has huge influence. And a bad CEO obviously can destroy a small business, because, as I mentioned, there is usually not a moat. So what I'm looking for, I mean, ideally it's an owner operator that took the company public, usually for excess of capital. But if there is not an owner operator, has to be a CEO with a track record. And I really want to have like a shareholder base where I know that these people are in for the long term. They have like a structural process, and just not like some institutions that flip over the stock and you don't have clear guidance. So it has to be a good board. That's mostly the thing with management. And if it's an owner operator, you usually don't have to care about incentives. But if it's not an owner operator, the incentives have to be aligned with. It's sometimes an issue with family-owned companies, because they are somewhat owner operators. But then it's like you have to think about, do they want to grow the business and share it with all the shareholders, or do they want to enrich themselves? And this is why you have to usually dig into the proxy statement or so if you find related party transactions. So that's part of the due diligence. You just have to see, like, what is their salary, where do they get the returns from, and usually if there is some track record and some communication, you will figure it out pretty soon how they think about minority shareholders. What helps as well is talking to them. I mean, I usually reach out to management teams or IR, and depending on the responsiveness of them, you know how they think about minority shareholders. So that's maybe a soft point that helps. Yeah, and finally, the fifth point is the valuation, and that's basically what I alluded earlier. If I basically just assume a maintenance business and calculate what would be the dividend that they could pay out, and if that's and usually I aim for like 10%, which is a high bar. It's at most 10 times owner earnings, and that's basically the owner earnings. It's how I think Buffett introduced the term, and it's what is a business if it just reinvests what it must, not to grow, what is left. And
usually, how long does it take you to analyze a company for all those stages, and from the process that, okay, this is a very interesting idea, till the point of the conviction, yes, I'm going to buy?
I mean, these are usually, because I do mostly small companies, they're easier to understand and to pull apart, but it usually takes, if I'm fast, it takes a month. Yeah. If it's fast. But usually if after spending one day, I'm not 80% there yet, so that if after one day I don't have the idea, oh, that is really something good and I understand it, then I usually pass. So after one day, I must have a very good, and the remainder of the 20%, the due diligence takes longer. But if I'm not there, like if I don't get it after one day, it's too hard, because you can make so many mistakes, and it should be, the business model should be very clear, because I think if it's very clear where the value comes from, then it's easier to do the analysis and also have conviction in the idea, if you know where they go.
Do you want to walk it? Gilad, maybe now's a good time for an example, David. Do you want to walk us down an example, maybe the company you pitched at the latest conference?
Sure.
I think,
no, we can do that. We can do
a good example.
No, that's a perfect example. So it's McFarlane Group.
It's not here yet. It's a newer one.
That is not in there. No, it's a great example. So we can take the entire funnel. So the funnel, like that piece was Yoav. So your fellow smart investor.
I didn't say just because of that. It was I didn't make up the company. Yeah, we'll give credit to the founders. Thank you.
So let's take a look at it. What's her name?
McFarlane, MAC.
It's a British company.
It's British.
Oh, let's try a FinChart. Yeah, we're
yeah, FinChart, you can do that. So
FinChart, we're now investigating there.
Go ahead, David. Go ahead. Yeah.
From the funnel, you have now
what's the name?
MACF is a ticker, I believe.
Exactly. Yeah, it's like the fourth of the bottom.
From the bottom.
Yeah. There, yeah.
McFarlane.
McFarlane. McFarlane.
Exactly. So, I mean, now we have you have mentioned the idea. Like
McFarlane Group, through its subsidiary, design, manufacture, and distribute protective packaging products to businesses. Can you please explain us what they do?
Absolutely. I mean, you have mentioned the idea, and I mean, probably, Gilad, you are as excited as I am about packaging, and you think it's the best thing ever since sliced bread. But he said, like, it's an interesting business model, and this is. I said, okay, if you say so, I will take a look. And if you start reading the materials and you look at the numbers, I mean, what you first see, like, it's cheap. I mean, the PE is
first, if I understand correctly, like it's almost a nano cap, right?
I mean, it depends where you are. I think for US, everything under $1 billion is nano cap, but in Germany, you would call this not even a micro cap. I would say it's a small cap.
But it's a very small company. 168.
Even though it's been around for a while, it's small, but it's been around.
It's like 126 years old.
Yeah.
Huh?
So, I mean, first you see it's cheap. I mean, the PE is 11. They even have some amortized acquired intangibles. So on a free cash flow, it's around 9 times. So, I mean, that's the first tick. So it's worth the look. Then you look at the business and you say, okay, packaging. You start reading the materials and you will recognize that while the margin is maybe not very good.
Please explain what is packaging. It's
what
like
is packaging?
Boxes for my toothbrush.
Everything. Think about everything that you wouldn't. If you can buy cardboard in the store and just throw it in the cardboard and ship it with DHL or FedEx, then it's not what they would do. What they would do is, if you have something, it's protective packaging or specialty packaging. It's when you have think about a company like a medical equipment manufacturer. Mm-hmm. Maybe you've heard about Thermo Fisher. That's an important customer. So a company like Thermo, they would have like small components that are high value, but because they have like 10,000 different units, usually they sell only a low to medium volume. So in every of these components, you have to package individually. And it's very important that they don't break. So you would work with someone like McFarlane, because McFarlane they have a manufacturing arm, but it's mostly distribution. So they don't even manufacture most of the packaging. So you would work with them and say, hey, we have like 10,000 different units and we need to package them. So McFarlane would look at your entire packaging process, would go through and say, okay, they would design a packaging specifically for that through a combination of like cardboard, foam, aluminum, whatever is required. And then they would even design a packaging process so that the employees can package it first quickly, but also safely, so that it's actually delivered and doesn't break. And And then finally, they would handle the packaging logistics, because what is usually the case is if they only sell a low to medium volume, so like next week they will sell maybe 100 pieces, but then it's only 3, and then it's like 200, and then they can just, McFarlane will ship the packaging on demand to them.
And
So
sometimes store
exactly.
it, David, correct me if I'm wrong, they also store it for the big, some
they
big
have-
companies don't want to have to deal with this stuff.
It's
They,
family owned. How much?
It is not family owned. It's actually, I mean, there is the CEO only owns like 2% of the company, so the insider ownership is not very high, but I mean the structure is pretty good. The current CEO, Mr. Atkinson, he came in around 2004, and if you look at the stock chart,
he's doing a great job. Yeah.
over the 20 years, like they were a struggling manufacturer of packaging, and like over the past 20 years, he has basically transformed it into this protective packaging distributor. So what they do is, I mean, they work together with their customers, and it's different to their commodity packaging. And I think that's the main insight that also led me to the investment is, if you think about packaging, like you think about manufacturing cardboard and selling it at a tiny margin, but it's a different value proposition. The value proposition is they will look at your packaging process, and through you working with McFarlane, you have an efficiency gain. The efficiency is that you don't have to handle the entire overhead. You have less damage in the product, which is a huge issue if you have high value products. And you have way more efficiency in the process, because these people, they design the process for you just faster. And that entire thing, their price for their service is basically a margin out of this efficiency gain, which is a way better value proposition. So they make more money. Even the customer makes more money. And that's the relationship that you want to have. It's what I just mentioned before. You want to have a business that has a good service for the customers, price it at a fair price, and does it over and over again very well. I think it's a perfect example. So what if you look at packaging distribution? It's still, I mean, the margin is better than other packaging distributors, but the net margin is around 5%, so it's still a low margin. But it's a high turnover and high return on capital, because they don't manufacture for the most part. It's distribution, so they don't have a lot of capex. They have a couple of warehouses, so the returns on tangible capital, I think, are in the 20% range, which is very, very good. And they generate a lot of cash because they have some working capital, obviously, but most of it is just like a service. So it's cash in, cash out. So what are they doing with the cash flow? So the business doesn't require a lot of organic growth, because, I mean, packaging grows with GDP plus a little bit more through being more delivered in the special industries, but it's mostly a GDP plus grower. So they will just acquire small local distributors. So your mom and pops that basically manufacture and distribute specialty packaging for their local communities and local firms. And they would acquire them very cheaply, usually around 5 times EBITDA, which is around 8 to 10 times free cash flow. And that's what they have mostly done over the past 20 years. 10 years since they've done acquisitions, but it's a very simple algorithm. It's like improve the service, make the customer happy, use the cash flow to buy smaller ones, and pay a small dividend.
Pay a dividend, yeah.
So that's basically it. And you have, I mean, the business model is what I said. I think they have a competitive advantage, because like this value added packaging is I would say an oligopoly in the UK. This is a UK based company for the most part. It's mostly UK, and there are like three or four operators who do the same, but they have different market niches. So everybody stays in his lane, which allows for good returns. So, and I mean, that's it. I think that's good enough. And the management is, although insider ownership is low, if you talk to Mr. Atkinson, as I've done, and you see his track record, he's been basically, this is his company that he's transformed over 20 years, and he continues to do. And I think you can have little small insider ownership. By the way, it's still a multiple of his annual salaries in the stock, even though it's a small ownership, but he's not the founder.
You've spoken with him, David?
Yes, I have, and I have spoken with him, and he's
good
just
for you.
a very rational operator that looks at the industry and basically does it over and over again. And it's and the track record at some point speaks for himself. He's done a tremendous job of taking a struggling company and transforming to actually a very, very good company. So the management like is good. And the financials, as I mentioned, like you have good returns on capital and good cash generation. So that's very good. And the capital allocation is actually very good. Growth with M&A can sometimes be a little bit tricky. But if you look at the track record, buying smaller businesses is usually a good way to go. And then if they even listed the acquisition, it's 5 to 6 times EBITDA. It's like a rule, they wouldn't pay more for it. So that's surely a positive thing.
That's what caught my eye in the beginning as well. Yeah, Gilad, I think has put the numbers that you're saying on a chart here. Gilad, you want to share us with what you found? Also,
No, we see the number. We see that their free cash flow. First, I want to talk about the stock price. I mean, from what I see, it's not very. I mean, the last 5 years, it's pretty much doesn't go anywhere.
Exactly. And I think this is very.
That's why we're value investors. We're born to suffer, wait and suffer.
I mean, that's
and get paid some dividends in the meantime.
Exactly.
And you're a British company. Don't remember that. You get another punishment for that.
Yeah.
That's why it's such a great investment, we think.
I think it's actually true. I mean, there are many headwinds. Europe, small cap, UK. That's not good by itself. Boring. It's. I think the industry is misunderstood, as I mentioned, because packaging it's bad business, but actually not. Yeah, I mean, it's. If you look at the stock price over a long period of time, actually it has went up, like it compounded pretty good. But I mean, over the past 50 years, as I mentioned, that the multiple just compressed, and I think that's the interesting thing. If you look at you can take earnings per share growth or whatever metric you want to take, like everything's just ticking up. And, I mean, there has been like post-COVID a glut in almost every supply chain. So for packaging, I mean, even if you sell specialty packaging, if nobody orders something, you make less money. So yeah, exactly. Like you can do dividend, you can do whatever profitability metric you want to take. I like to have, I mean, earnings per share and sales went up every year, and the margin expanded. And I think that's also something that is not appreciated, is like the margins continues to expand. I think earnings per share compounded at 10 to 12% over like
free cash flow over
years.
the past 10 years have compounded. I'm looking at QuickFS at a 28%
Yeah, I mean, that's
yearly.
impressive.
That's crazy. And you're paying EV to free cash flow today of a 6.4. So
yeah, so and I mean, that's what I said. Like, this is why I think it's so important to buy cheap enough so that you can get a good return from the business itself. Because I mean, Gilad, you said it, like, I mean, the business can do whatever it wants. If the stock price doesn't move, what do you want to do? And if you pay like below 10% free cash flow yield, like now you get a 4% dividend yield that usually grows at least 10% per year.
Okay,
So
I want to try to bridge a gap. I mean, as a professional that work with it and look within, okay, feel free. But as someone that wants to see his money grow and bought this stock like 3 years ago and see that it didn't do anything, what is your expectation? What is your what do you believe that will happen for you as an investor in this kind of stock?
Got it. I mean, first, I mean, let's say you have bought 5 years ago. I mean, the past, like with the supply chain, let's say 5 years ago, I think the stock didn't move particularly. If you look at 5 years ago, and the stock was actually not that cheap, or let's look at 2018, 2019, as your revenues like have been materially lower. So that's why I think it's very important to buy at a good price, because I mean, you can grow. Obviously, you can grow into a higher multiple. But I mean, it can happen that you wait 5 years and nothing happens. And so when I buy something like a 10 times free cash flow, I said, if the company executes, and like there are two ways with McFarlane that we can see. I mean, if they continue to grow the free cash flow in the teens, like then the dividend, like it's currently, I think, almost 4%, like the dividend will grow at the same rate, like 10 to 15%. So the dividend yield, the dividend would double in 5 years. If the stock doesn't move in 5 years, you get an 8% yield. That's, I mean, then you get your cash. This is what I mean. Like, you get the cash from the company back. And if they cannot grow, they can pay a higher yield. Prior to 2014, they didn't do acquisitions. But they paid like the payout ratio was double. So if they run out of growth, Like what I mean with growth capacity, if there is not enough capacity to
NA
grow,
and stuff.
they would
Or
double the
NA.
payout, and then you would almost get an 8% yield right away. And I think that is something you can rely on as a quote-unquote margin of safety of some sort. You get a yield from the company that either grows very rapidly, or you get just a high yield as you have said very eloquently, but for waiting. And that's
Okay,
how I think about it.
let me try to translate it to human. Okay, so basically you say, yes, the stock price might not do that bad, but let's say I'll get now 4% dividend. It's like buying a coupon, a bond, and plus I have a good business that might increase the coupon. So maybe the fair rate won't change that much, but I still have a good business that provide me good dividend as a cash flow. And I believe that sometimes it will be reflected in the price when somebody will notice it, and the wind will change for the UK, everything. But even if not, I have my payout and I see my, as you said, my return from the business itself. Well,
Exactly.
you don't have a lot of time, David, and I do want you to go over and explain to us those metrics that you put in your letter.
I had one question just for McFarlane, David. If Gilad, go back just before I move on, if we can.
Yeah.
And this is also, I think it's relevant for a lot of people that are listening. Well, part of the thesis here is that is a multiple will go up. Such a great company will not trade at such a low price over time. So what my question to you is, and this connects to a previous podcast we did, and I think don't know if you heard my speech at the conference about selling a great company. And let's say this company does trade at a 20, 30 times free cash flow, meaning the yield will go down to 2 or 3%. But they continue growing the free cash flow double digit. When would you sell it? Or would you sell it at all? Or did I convince you that a great company should never be sold at all? And by the way, Gilad was a great help with the research, so I think this will be interesting to you.
Assistant researcher.
Yes.
That was actually a great research, and I liked it. And I think what I took away from it is, it is bad to sell a good company that has appreciated if you don't have a better idea. Going into something like cash, or I mean, you mentioned this S&P 500 even. It's not a good idea to sell. I mean, and then you put taxes on top, and it gets even worse. But I mean, that's what I think. It's just I think a high valuation creates risk, because you get a lower yield, but also like it trades at a higher multiple, and if it doesn't execute, like the multiple will go down again. So I wouldn't sell the business just because it's expensive. But what has until now always happened is I find better ideas I track, and then I just take the capital from the expensive one. Because if you think about it, if they go to 30 times free cash flow 5 years from now and they double free cash flow, it's a six-bagger. So it's a huge gain. And then that also implies that it's a huge part of the portfolio. And then you take some of the money and put it into better idea, where you have the same level of confidence in the business.
Hopefully you're in a tax-free account.
I mean,
with TerraVest, we can connect now to what Gilad is showing. With TerraVest, I think you had that big problem. I'm not sure how you dealt with that, but
okay. So let's go over your portfolio, the one for December that you sent. And I want first to say, so you give the number of the company, the percentage that it's from the portfolio, the return since inception. First, it's very nice. You did 28.5 return in 1 year until December 24. It's a very good one. And then you give owner earning yield. What is it?
That is exactly the metric that I mentioned. So how I think about it is, that's the baseline return, especially the owner earnings is the free cash flow that you get if you only include the maintenance capital expenditure. Basically, what could the business pay you out in a dividend? That's the dividend yield if they would pay out everything that they would need to just support their business. I mean, that's the maximum that they can pay out.
How do you decide it? How do you decide what is this number?
I mean, there are multiple ways to do it. I mean, if you have free cash flow, then you just add back growth capital, capex. I mean, capex is basically everything that you invest in your property, plant, equipment, and usually that is a mixture between what you just replace. You replace equipment and you buy a new one, or you buy a new facility, and you would just add that back that you invested in growth, because that is that one that you used to grow. So I think that's important, because why is that important? Free cash flow on its own, you can have a company that has zero free cash flow, but it can be very cheap because it invests everything in growth. And if it has a good return on capital, it will grow very fast. And if you just look at the free cash flow, it's low or sometimes negative. So and you say, oh, that's a bad business and it's expensive, but it's the wrong metric. So what you want to have as a view on, you have to have the equal, let's say the equal playing field for all companies. So you'd say, okay, let's assume everybody cannot grow. How expensive would it be? And that's the view. And then you look at this is why the next two columns are important. What will they do?
Just one sec first for this one. Do you use different formula and different calculation for each company, or it's the same for all of them?
I mean, the calculation is mostly the same, but it's more important. Sometimes it can change. You have to think about stock-based compensation. I mean, there are nitty-gritty details, but this is why the economic principle is important. Like, for example, some software businesses, they would invest what you call through the income statement, because their capex, quote unquote, is buying or hiring new engineers to write software, right? So you would often find software businesses have great gross margins and very low EBIT margins. So you have a huge differential, because every dollar they make, they would hire new engineers. So you can see that as a capex. So it's important to think, okay, just put the company, like if it couldn't grow, like what would the structure look like? So for industrial companies is largely what I said, it's free cash flow plus growth capex. But for software,
so this is what the company earns without growing.
Exactly.
Just maintaining its existing operation.
Exactly.
Doesn't work to grow the company, just maintain. This is what you as an owner will receive.
Exactly. That's it.
To use my allegory from before, this is the coupon.
Exactly. That's a coupon. That would be a coupon from basically a bond. Exactly.
Exactly. So, okay.
And now, I mean, what is important? Because if you think about, okay, now you have the cash. So you look at, okay, you're an investor. You have your target rate, like what's your IRR? What do you want to make? The equity markets usually implied 10%. I mean, that's what markets have done over the long period. Maybe you're very skillful, you can do 15 if you're very, very good. There are businesses that have returns on invested capital in the 20s. What that means is every dollar that they retain, they create 20 cents, like 20%. That's better than most other investors can do on their own. So if you have those businesses, you want them to not pay out the yield. You want them to take that money and reinvest it in the business, which is growth. Does that make sense?
Yeah, very much.
Exactly.
It's very clear.
So for most businesses, they cannot invest everything because there is not enough capacity. So they will choose a kind of mixture. They will pay out something and they will invest in growth. And this is why I use the implied growth rate and the implied shareholder yield. That's basically the same concept. I say, okay, the owner earnings yield is the theoretic yield you would get if they pay out everything. And then it's okay, they pay out everything. They have a return on invested capital. Maybe if you have a good company, it's 20% with McFarlane, and they would maybe retain 50% of cash. So what you get? You get a 5% yield. Let's say we buy at a 10% free cash owner earnings yield, 10%. They retain half of it. So you get a 5% yield, they pay out half. And the other 50%, they reinvest at 20%. So this would imply a growth rate of 10%, because half of 20% is 10%. So
this is very similar to a formula we talked about here, Shree's formula. Gilad, our listeners are familiar kind of with this thought process.
Exactly.
You're familiar with him?
I think they use a very similar method.
SVN Capital.
So, and then you get your total return, and that's the last column. So it's the growth plus the shareholder yield, because some companies pay dividends, some buy back shares, and some pay down.
So let me see if I understand. Implied growth rate. This is what's the difference? Implied growth rate is what you expect the growth rate would be based on their reinvestment percentage and their ROE.
Exactly. That's the point. Because why is that implied? Because there is cyclical. You mentioned it. Every industry is cyclical. Everything is cyclical.
Tariffs just had their numbers yesterday, so their growth rate was the same, just negative. So it's implied. There are no guarantees that it will be like that every year.
You wanna look out and say, like, what is if they reinvest at that return on capital? and assume that the capacity, like if it's not there yet, maybe it will be next year. So if they continue to do it,
and what is
over and over,
implied shareholder yield?
that's what you get out. But that's basically
That's
dividend
what they
yield.
actually pay as dividends.
Exactly.
The first one is what they
Okay.
they could. This is what they actually do if they also reinvest.
Exactly, and that can be a buyback and a dividend yield.
So let me see if I understand. So you say the business as it is without growing produce 4.6.
Yes.
By reinvesting part of it, I think it should grow 17.6% in the future, and 1.1 I received. So my total return that I should expect from the business should be 18.7%.
Exactly. And I think that is, and what I like about it is like on the left hand side, the 4.6. That is I consider it like if my analysis is correct, which is not always the case, but then you have a flaw. It's very hard to earn if they're rational allocators. There is a flaw on the yield. Like they have, if they don't burn the cash, you get their own earnings yield. And on the right hand side, that's your maximum.
How often, David, sorry to cut you off. How often do you update this? Every time they do earnings, or just once a year?
I'm not that often. At least once a year. I think like quarterly earnings can be very noisy. I do it when sometimes it's triggered by earnings, but most often it's just I go through it regularly and then I reassess it. I think it's not important. I mean, some people I think do it quarterly. I think this is not
unnecessary. Yeah,
it's mathematically. It looks mathematically precise, but obviously, like there are so many assumptions. You just wanna. I think it's very good as a framework, because on the right hand side, the 18.7% is like if most of it goes right.
Okay, let me try to summarize, and then I have another question for you before we're gonna send you back to your business. So let's try to explain it like this. Owner earnings yield, it's what the business produces just as a business, like any apartment would produce, or any coupon. The growth rate, it was that you believe that the company can increase its earning in the far future. Let's say if we use the apartment, if this apartment could be like create small apartment as babies and reproduce itself, or you can do Tama 32 in Israel, we have like to improve and you get some more percentage. So this is what it will grow, plus the yield, this is what you expect and eventually you see, this is what I'd expect the business will produce to me, this is what I buy it, I love it. Now, I'm going to ask you a question. I look at this table and I see that you have like 5 or 6 companies here, 5, that have decreased in their value tremendously. I have one minus 454 of 123, while they're expecting implied total return is greater than the others. Would you go now and buy more of this? Let's say you have another dollar coming into the fund. Will you buy all the companies in the same ratios, or will you allocate more to the one that are producing a better implied total return?
I mean, thank you, Gilad, for pointing those out that where I am terrible. So thank you for bringing that to the audience.
Well, we don't know if it's terrible. We don't know. It's terrible by now. Maybe it's a great opportunity. We quote here a lot Wesley Gray's research about even God will get fired. Sometimes the one that went down are the best investments you did. It doesn't mean you're wrong. Maybe it's just a process in the way, although maybe this is the best opportunity. This is what I'm asking. I'm asking, maybe this is maybe those are the best stocks to invest in.
I was half joking. So, I mean, obviously, as every good investor would say, it depends. So, I mean, with if I invest the money, if it goes down, I mean, it can have rational reasons, like something happened. I mean, with the solid state that is down 50%, there something happened actually. They didn't get a contract that they anticipated, and for a small company, one contract is big, so the stock got sold off. So now I think it's a good example. So you sit there and say, okay, I mean, obviously the intrinsic value has decreased at least for the short term. So you have to think about, okay, will the contract be there? What will they do with the capacity? Is it rational? So it's an assessment. Like I usually tend to do nothing if I think that the business isn't.
I'm asking a harder question. You do nothing, but you'll get another dollar. Not
say
I will invest $1 in the fund. How will you allocate it? Okay. Will you allocate it in the same percentage that they are, or will you increasing the one that went down more, or have
You might
better
have
implied
you might have
total return?
prospective
Yeah,
clients and with the audience, so they want to know what would you do now.
I understood. I mean, how I do it is everybody gets the same allocation. I mean, because how I think about it, if a new client comes in and if a new client would come, he would get a brand new portfolio in his, I've done it for a period of time, but he gets a brand new one. And then I think, okay, if I would do anything differently from how it's currently allocated, then I would reallocate all the portfolios, because everybody gets the best portfolio. And I think this is actually a great example, because I don't know who said it, but I said, like, every time you don't sell a stock, you buy it. And I think in a fund, you said, right, if you have a fund and it's one pool of capital, new dollar comes in, like it messes up the allocation, because now you have cash. But if you have managed more accounts, like, you look at the other accounts and they say, you have to actually buy all the securities again. And I think I always use it to re-underwrite the positions and the sizes. And I think, if I'm confident, they will get the same allocation. But if not, I spend a couple of days and think hardly about it, if I should move some. And I think that's an advantage of having individual accounts.
Gilad, I told you David would be good, but I think we have to let him go. We promised.
Yeah.
If you have a couple more questions, I have a couple more minutes, so don't.
No, I think you gave us a lot of information.
I told you he
listen and see, he gave the Excel sheets and everything and all the information. Please go and subscribe to his blog and pay whatever needs to get. If you want, it's very, very interesting.
But the old stuff is free, David. Sorry, I'm mentioning that, but you told me so. The old stuff is free. The old blog posts that were free up to a few months ago are still free, so people can read a lot.
I think the blog posts are still free, but just without the update of the portfolio, right?
There is I write one write-up a month over a company I discover, and I write a deep analysis on, and that is paid now since beginning of this year. But the older ones are still free and will remain so.
Wow, David, it was very, very interesting. You gave us a lot of great information, and think you're doing a beautiful process. And
makes a lot of sense, huh, Gilad? What he does.
I love it when we have sense. This is what I love about value investing. It makes sense. You have reason without it. It's not something. I used to tell you, I'm 20 years in the financial business and listening to very, let's say, famous economists and investors and money managers. And usually they used to talk and I felt stupid. And I said, I don't really understand what they're talking about. And after like 15 years or so, I understand, well, that's because they don't really know what they're talking about. They're just talking about things that sounds very sophisticated. And when I come to the value and I can understand the inner reason of it, maybe it's right, maybe it's wrong, but you know why you're right and you know why you're wrong. I love it. I love it much better. Would you like to give a recommendation that is not related to investment, something about life that you want to give to our audience? We usually finish our podcast with some general recommendation that we enjoy for our life. Sure. You can think about some. If you have one, please.
Obviously, I'm German. I'm prepared. So, first I want to thank you guys. It's an honor. It's a pleasure it's a privilege to be on your show. It is usually in Hebrew, but apparently my Hebrew is not good enough, so we had to do it in English. So, thank you.
The privilege ours, David. You did a great job. Thank you.
So, what more advice? I think what is in the investment world that we tend to be a lot of, like you see, like numbers focused. You read a lot. Everybody usually reads a lot, talks to people, but I would say, like, go outside and walk. I walk almost every day. I think it just helps to combine the dots. I think it's in the investment world, it's hugely important. You consume the information, but you have to build the picture, and it helps just going out, be in nature. It's good for your health. It's good for your mind, and it actually helps your process. So slowing down a bit and doing that, that's a simple advice.
Great. Yoav, what is yours?
Mine is actually, I won't go into last night. That sounds not too good. I was at an event that two guys, Israeli money managers, Moti and Shachar, had. By the way, they have a podcast in Hebrew. It's called Mima'of Tzipor. I'll put a link just so just בשביל לפרגן להם, so in Hebrew, they're two very nice guys, young managers in the beginning, and I want to recommend their podcast and the evening they did for Israeli managers. At the end of the evening, I'm going to surprise you, Gilad. They gave us all a present of it's a quality coffee that it's a new company. It's a startup. They have some I think they invested in. It's called Krima. Have you heard of it? So they give this, okay, so sometimes even in coffee I can bring you new things. I'll put a show along to there. They give us a huge box full of goodies, coffee, mainly coffee, but also chocolate. It looks great, and I'll be more than happy to put a show link, and maybe Gilad, you'll find out.
Bring me the coffee. What do you mean?
I'll save you some of the coffee. No problem. You got it.
Okay, my recommendation relates to coffee too. I have an okay espresso machine. It's not like really, really fancy, but it's like, I think, like above entry level. And it did some problems, and it's the brand is L'Elite. It's an Italian brand. And it did some problems, and I took it to the importer. It's called Cafe Russo in just outside Tel Aviv, Belud. And they take such good care of it. I mean, I must recommend them. If you are into coffee, they really, really took good care of it. I just brought it back today, and wow, I just called them and said thank you. They like polished it and make it nice, and they charge really, really a small amount. It's like you feel that they love their job and they love to do it, and it's like wow. So thank you very much. And if you're into coffee, and if you want to treat yourself to a good espresso machine, I would recommend L'Elite.
You don't have to go to Europe.
No, of course.
But you should.
Well, we'll wait for spring to come to Europe.
Yeah.
But L'Elite and their important Cafe Russo really, really want to give them a shout out. Great service. And it's very great. David, thank you very much. We'll keep following your blog and have a lot of success with your fund.
Thank you, guys.
Family, David also is expecting in a few months as well. So his wife is expecting.
First child?
No, second child.
Second. Okay. Wow. You're about to become a family. Great.
That's true. No.
It's great. Wow. Congrats.
Send best regards, David. Thanks again for coming. I think we haven't had too many guests, but you've been the best from my side. And we've had some famous ones.
Thank you. Oh, that's
I think David. William Green gives him a tough run.
But William is amazing. But David, with per investment material, I think we have
we can agree on it.
No تخوت.
Thank you very much. Bye, guys.
Bye.
Bye.